Yo, what's going on? Welcome back. Today we're going to be going over why I don't use daily bias anymore, and honestly why I don't think you should either. And it's a very simple reason. I get it all the time. It's like one of my number one questions I get is, what is your bias on the day? I go live, motherfuckers are talking about what's your bias? What's your bias? And honestly, I hate to break it to you, I don't have a bias. I don't have a uniform. This is the type of trade I'm looking for on the day. It changes because I know one simple thing: any high and any low can sponsor a completely new move. It has nothing to do with the name of the high. It doesn't need to be a London high. It doesn't need to be an Asia high. It doesn't need to be a New York high. It doesn't need to be a New York PM high. Any high and any low can sponsor a move. Once you know that, then having a bias is only going to debilitate you. I say this all the time. You do not want to have a fixed bias in the market. I see this in my DMs a lot. People will kind of show me screenshots of trades where it took a high or took a low, and they're like, why didn't it deliver away from this? Why didn't we retrace out this higher time from inefficiency? Why didn't we XYZ TJR reasons for why it didn't deliver in the way it should have, based off of preset notions at a high or at a low? And I kind of want to change your mind, at least a little bit, as to how you should view the market. I think a daily bias is just a bad approach. I don't think if I were to ask you, okay, what is a daily bias? What's the point of a daily bias? You would say the idea is to have some type of directionality for the day. Bias on the day. That's what a daily bias is used for. So, that being said, have you ever seen a set of confluences that can be used in the same exact way every day, infinitely, 365? What would they be? Right? Sure. Will a London high sweep with a high time frame inefficiency, would that maybe deliver to the downside a percentage of the time? Yes. But what about continuation trades? What if there's no orders at the high? Why would you want to set up a fixed approach to a high or to a low, or whatever bias type of model you use, when instead you can approach any high or any low or any set of confluences in much more of a dynamic range, understanding that any single high and any single low can sponsor the move? It's going to save you from taking stupid trades, right? Because ultimately, we don't know where people are and how many people are at any high or any low at any given time. We don't know if there are still orders at the high or orders at the low. That's why we test them. That's why when we buy side or sell side sweep into highs and lows, we read what happens off of that high or that low. If we see an opposite-ended impulse reaction to the high or that low, what that means is that the opposite type of order is still relevant in either limit or market orders at that area. There's still supply, there's still demand, they fill their orders. If you entrench deep enough, right, and you take out enough stop losses of that order type, enough of those orders get converted into the other type of order, right? Because what is a buy stop? What happens when a buy stop gets triggered? In order for that person to close their trade, sellers have to absorb that position. That's why you'll see when support breaks, it becomes resistance. When resistance breaks, it becomes support. One type of order, when stopped out, here's your stops. When you get to the stops and you remove those stops, someone's got to be there to take it from you. It's going to be the opposite order type. And so we need to be a lot more open-minded about what can happen at a high or at a low, and using a daily bias is only going to inhibit you. I used to teach a daily bias, and now I use more of a dynamic bias, which is an approach to every high and any low. So we're going to kind of go over how I approach my trades and realistically what my trades look like. I think people struggle with that, to kind of capture like what would my moves look like if we had them, right? You see it in trade recaps, but you don't really get the full picture of what exactly they would look like. What does a successful macro model trade look like? What does everything else look like? Okay, we call them implied moves, whatever macro model, whatever you want to call it. I used to use the daily bias to explain what I used to do. Is I would use PDH, PDL, and PDE to sponsor moves. So if we opened up at PDH and had PO3, we would call it a chop until the PO3 conditions. There's a video on my YouTube channel about that as well. If we took PDL, we chopped, same exact rule. If we took PDE, we chopped, same exact rule. It all depended where EQ range would fall. If you don't have it, you can just flick on EQ range. It won't be available during Asia session since it uses the Asia session data. But assuming we're in like New York session, for example, matter of fact, here's a really solid example. We'll go in here. This is kind of how I used to do it. This is the New York Open right here. We're going to throw an EQ range. We're going to look at where we open in relation to structural, previous daily high, previous daily low, and previous daily equilibrium. We'll just throw an EQ range real quick in here. And we're going to go draw a GAN box on PDH to PDL here. Okay, so this was Monday low of day, okay, and then Monday high of day. And I would use the New York Times. There we go. So there's PDH, PDL, PDE. We opened up at PDE, right? Here's your previous daily equilibrium. We opened up at PDE on the market open and in EQ range. So therefore, I wouldn't trade until we had a new withdrawal in liquidity from a low or a high that did not sponsor the P03. I always say this in all my videos, but why would you, the whole mentality of our bias is to take market state transitions. How is a manipulation on an accumulation and market state transition? Please let me know. Because if you look at an accumulation, right, what is an accumulation, right? It's manipulation off of lows and highs, manipulating off of lows and highs back into the nearest most available amounts of orders. That's why you see P03, which is essentially pointers effectively validating the range, right? There is no breakout because you'll get your pointer in here, you'll get your pointer in here, you'll get your pointer in here, you'll get your pointer in here. The reason why you don't want to trade during this chop is because oftentimes where that bullish or bearish pointer is going to deliver, you can imagine that these lines are the FFEGs that hold together the accumulation range, right? Oftentimes what will happen is you'll enter on the pointer, right? A bearish pointer in the chop, and the close of the pointer is actually, or the close of the pointer is actually going to be the open for the next. Well, will always be the open in the next candle, but it'll be the low of the bullish pointer in the inversion. If you do that too many times, you're literally just taking loss after loss after loss after loss, and that's why we have rules to protect us for this. Go watch that video if you haven't already. So my previous bias model would match and pair EQ range to the structural EQ and say, okay, we're clearly in a structural equilibrium. And then obviously we opened up at that. Market's going to be relatively dead. And it did a decent job, but the problem is there are still moves that can be taken advantage of. And in fact, I think we even get something without the PDL sweep. I might be wrong. I forget what it was. Yeah, if you notice here, right, we didn't get deliverance off of a previous daily low draw on liquidity, right? Here's your previous daily low. We didn't get a PDL draw on liquidity. What did we get instead? We got the FFEGs off of previous daily low that sponsored the move. So already you can see that just because you take a previous daily high, just because you take a previous daily low or don't, doesn't mean you can't have moves, right? Sure, can there be moves where you take a PDL and go higher? Can there be moves where you take a PDH and go lower? 100%. But that's not how you set a bias. Your bias will be determined off of any single high or any single low. And once you understand that, you can really get a good grasp on efficient price action, because when price is easily manipulating off the most local highs and the most local lows and the most local FFEGs and the most local IFFEGs, and it's just pointing in between them, that's a chop. When price is able to extend towards draw on liquidity and react to some type of inefficiency, this is how we can create biases. Now, I used to teach this in terms of, okay, you have a high, you have a low, your previous daily high, your previous daily low, previous daily equilibrium. If you open up on chop, your cookies. But if you take the previous daily high, you can take shorts as manipulations, longs as continuations. If you open up on the PDL or take the PDL, you can take manipulations or continuations. But it's tracking me, isn't it? Okay, thank God. I was about to have a generational crash out. But honestly, think about it. Why does it have to be PDH PDL? It's just what I did. I traded options, right? The reason why, here's the kicker, the reason why everybody teaches a daily bias is because they take one trade a day. They only need to have a bias on the day because they're only going to take one trade a day. I promise you, and I urge you, go watch any of your favorite creators that teach daily bias. I promise you, somewhere, even though they might contradict themselves, somewhere in their teachings, they will tell you they take one trade a day. I do not take one trade a day. So having a daily bias is nearly impossible, right? I'm not going to have a specific bias on the day, the entire day. So when people ask me, what's my bias? The answer is whatever sets of conflicts I had before that, right? And that could change instantly. And people hate that, right? People that watch me, they hate that. They're like, well, fuck. What do you mean you don't have a bias? How are you going to take a trade? What are you going to... Daily bias is only going to set you back because you're going to look for trades that are going to be the exact opposite of what you could be taking. Instead, you're waiting for a fucking previous daily low sweep. You're not going to get in on a trade because you didn't get a new draw sweep. The market is kind of like two buckets. This is the way I like to explain it. The market's like two buckets, buy side and sell side liquidity, right? And what you have to understand is every single high and any single low contributes to the amount of liquidity available and accessible on each side. So, just because it doesn't take, there could be nothing in a previous daily high or previous daily low. There might not be any orders as limits or market orders queued at the high or at the low. There might be nothing there. There might not even be stop losses either. There might not even be new fills. What matters is what we've been doing and the sets of confluences we get after some type of total flow change. A total flow change, all that a total flow change is let's say, this is our sell side cup, okay? And let's say that this is our buy side cup, right? You can see a total difference in the total flow. The total flow is the number of orders, right? There's clearly a difference in the number of orders between these two cups. When you take out draws and liquidity and you convert one type of order to the other type of order, for example, let's say this is our buy side liquidity, right? So this is going to be the sell, like the sell stops, right? And this is going to be our sell side liquidity, which is going to be our buy stops. If you think about how this would work, right? If you take out the buy side liquidity at the highs, right? And you take out enough orders, or you fill enough orders, the amount of liquidity in that side is going to drastically shift. And if you get some type of lean or tilt in the market where an excessive amount of orders come into the market, this is how imbalance is created. Imbalance is created after some type of draw on liquidity. This is why when you talk about fair value gaps, the first step of a fair value gap is to do what? Have some type of local inducement, right? For the most part, some type of local inducement. That's why most fair value gaps are first fair value gaps for the most part. There's some type of like lower time frame inducement. Sometimes they happen without that, but I would say if you pull up 10 fair value gaps, at least 7 of them are going to have an inducement on them to some extent. When you have this imbalance here, it's going to be expressed through fair value gaps and through volume imbalances and rapid price development. And obviously the market's going to seek to rebalance this out by taking out the opposite type of orders at the highs. If the buyers are in control of a particular leg, they're going to retrace out all the sellers to then equalize the market into some range of fair value. And maybe that means an excessive expansion and then a high, some crazy take at the high and then dump to fair value, whatever that may be, or immediately deliver to fair value, right? We dump off the open and then we take out a low and it immediately equalizes, then we chop. That happens too. The problem is when you start to put names on things and say, oh, I need this high or I need this low to be taken in order for this to happen. I want you to understand any high and any low can contribute to the total float change. How our model works essentially is we know that every high and any low will just slowly add more layers. Here's a high, here's a high, here's a high, until the imbalance is so great that you have no other choice but to deliver down to the most local known area of orders. Like it's kind of like it's like a scale, right? The only way you want the scale to be balanced, the only way to balance it is to put more weight on the other side. That's the only way to do it, or take off weight. It's the only way you can do it. And that's either by absorbing or taking out orders. But just getting a liquidity sweep is not enough in the market. You can't just sweep out orders and that's enough to maintain the direction of a leg. We have a total float shift, which is a draw on liquidity. That's why with PO3, take a look at our PO3 rules. What's our rule? The PO3 count resets anytime we take a high or we take a low. That does not mean we take a trade, because obviously you don't want to take the manipulation back into the same accumulation, right? That doesn't make any sense. You want to take a transition, some type of transition out of the range. So clearly we know that it's not the draw that matters. So if your bias model is based off of a draw, you're already cooked. I'm proving it to you in real time here. Any draw can add enough to overflow one side of the market. What matters is the sets of confluences that present themselves after the total float shift that come with that of a rate of change. Total float shift is just saying, hey, we take people from here, boom, we make an inefficiency. But how do you maintain that market structure, right? How do you get the continuous bearish movement to the downside? How do you get that? Well, that comes with the new people getting in, right? Just because you stop people out and have a liquidity transfer does not mean you have a state shift, right? You need to convince people to then convert even more orders in an inefficient way to the other side. Make a big change. You have a losing team. It's like you have two teams and you can change teams anytime you want. And you have an event that takes 20 from one and puts in the other. That's the inefficiency. The people over here might not be confident in their team anymore, right? So they're going to slowly position themselves, or maybe even and aggressively withdraw themselves and get to the other side of the winning team because they don't want to lose. That's the idea of a total float shift that comes with rate of change. Rate of change is the structural stuff that you see going on, right? The total float shift is really just a high or low that gets taken out in response to the move. Let's say we have an expansion and there's like a high here, high here, high here, and you're waiting for this PDH to be hit, but let's say the cup overflows here. We take out the high, and then let's say this is where the rate of change symptoms come in. This is where we take our entry model, and we never take out this PDH, right? And you're sitting here fucking waiting, my bad for the handwriting, you're sitting here waiting for the fucking PDH to be hit, or the London to be hit, or the Asia to be hit, you're studying the wrong thing. You're studying the total float. Total float can change anywhere. What we want to care more about is what the rate of change symptoms look like with every single total float that will statistically produce the market state change. What do these conditions look like? And all that is pointers and FFEGs. Believe it or not, pointers and FFEGs come with every single implied move. That's rule number one of pointers. Every single implied move has a pointer, has an FFEG, has an IFFEG. And so when you get this delivery, as long as we're not immediately at fair value, because think about it, right? What could you have underneath of us? Let's say to equalize the market, all we need is 50 million orders. Since there's 50 million sell-side orders here, sell-side orders here, right? You take out those orders, you immediately start chopping, and then we get PO3. That can happen. There's nothing you can do to avoid that besides throwing on EQ range and just, kind of reading PA. You've got to throw money at this stuff to really find out, because otherwise you may miss the move. It's knowing how to get out of that and not continue to trade that. That's where that's where profitability is essentially. So stop focusing on the draw and liquidity. Stop focusing on waiting for a specific high or specific low to get taken out. It's cups. They overflow at any high and any low. And FFEGs and pointers are what sponsor the moves. When you study this, you'll realize it very quickly. Obviously, when you get the opposite delivery over and over and over and over and over, that is a chop. So I used to use a daily bias profile that was concerned with a PDH sweep or PDL sweep. And it would be much higher time frame, right? Convictions where I would hold these biases down for multiple hours. And it's because I took one trade a day. A lot of you guys are trading my model and you're trading it mechanically, right? And you'll see many inversions. You'll see many different entries, etc. So if we're kind of going to look at this day, this is a really bad day. In fact, let's go over here. I think I had drawings right here. These are two trades I took on Monday. This would be a better example. We had a bank holiday today, so I don't want to go over those examples. This is a really good example here. I did do a market recap on this as well the other day, so we can kind of talk about this a little bit. Give it a second. We'll turn on IFFEGs as well. We'll need those to help explain these moves, maybe even the other equity. We'll see. I forget. My memory's bad today. There we go. Yeah, IFFEGs on NQ. So instead of being concerned about the high sweep, because let's figure out where PDH is, right? What's the most common bias model that exists out there? Short off a high, long on a low, right? Go with a fucking order block, fair value gap break, and structure validation. Take it to static draws and liquidity. Don't even get me started about having targets on static draws and liquidity. It's the dumbest shit you could ever do. Because why? Any high and any low can sponsor the market state shift. It can sponsor the rate of change, or it can't. All these lows here may or may not be contributing to the overall structure. Where's the easiest part of this move? Where there isn't any high res liquidity. Where does it start to fucking get cooked? At the high res liquidity. Why? The total flow is changing. But then there's a bunch of fake outs in here. How do you differentiate the difference? Well, that's where you get the pointer rule. That's where you get our entry, the FFPG, the entry model. That's how we get in on the state shift and not in on the fugazi, the bullshit, right? You don't want to target the low. You don't want to target the high. You want to target the conditions that present themselves at a high or at a low that say not only was there a total float shift, but also there was a rate of change shift. Not only did you remove people or add people from one side, we don't know, right? If buyers are being added or sellers are being withdrawn, we don't know what the difference. It doesn't matter. We don't care the difference, okay? What we care more about is the confirmation of continuous transfer, right? Scare them enough to get to one side and then continue to keep them funneling in that direction. That is where my shit comes into play here. Don't target lows, don't target highs. Target the conditions that would say reversal or consolidation. That's exactly what happened in here. Obviously, a little bit more complicated when I'm using like squid on the side, but you get my point here. So instead of, look at here, right? Let's outline all the manipulations at highs during the accumulation that we can, or lows, that fucking failed, even with pointers. And I'll kind of show my examples here. Look, right, bullish pointer right here. Oh, you guys can't even see. If you zoom in on this chop, you'll see the bullish pointers immediately deliver into bearish pointers, and you're losing on all of these trades, right? Bearish pointer, bullish pointer, bearish pointer, bullish pointer. Exactly like I said before, where you'll have the instant delivery of the opposite pointer at where you entered, and you just get cooked because you're taking manipulations off the draws that are keeping the accumulation together. Instead, what you want to wait for is the continuation to present itself off the FFEG or the IFFEG, somewhere at the top end of the leg or the bottom end of the leg as a breakout. And if you get the opposite type of pointer, then it's going to manipulate off the high and go back in. Instead of taking the manipulation, wait just a little bit for the continuation to present between both equities. We get a continuation model off our open. This was pre-market. Again, go watch my trade recap if you want to see this particular trade. And what's happening as we're pulling into these highs from way before, right? All these previous highs, what's happening? You can see high risk highs here, high risk highs here. As we're pulling into these highs, we're adding total flow to this. So we're seeing a little bit of transfer, but it's not enough to sponsor the overall move. We need to have the rate of change symptoms being the pointer. And in this case, I believe a untapped FFEG that was created off of a buy side sweep in this leg here, right? It wasn't this one. It was what happened on the inside of the range. Again, go watch the video if you want to see this particular trade. When you're in this trade, we're not targeting these lows, right? We're not, we didn't even take a fucking previous daily high, right? We didn't take the high. You can see that right there. We didn't even SMT on the high, right? Otherwise, the indicator would say that. We didn't even SMT on the high. We didn't take the high. Here's your New York AIM high. We didn't do shit off that. So by almost every metric, you wouldn't be trading this, right? You've seen it. Just one example. The first example, we didn't even take a high or a low. And here, again, did any of these lows sponsor the move to the upside? No, but they helped. They helped one by one. They helped. There will be one final low that ends up being the one that changes the total float enough to then create the rate of change symptoms, being the pointer and the FFEG. But why would you want to exit on that on the low or the high? There are some differences when you're taking profits with my method, but like, why would you, if we clearly see that the static draws aren't the ones delivering price in every example, why would you have a bias for your entry on that? And why would you have a bias on your exit for that? None of these caused the market to change. It was the symptoms that came after all of the new draws that then added up to that. So ditch this idea of needing the sweep of whatever high or whatever low you're looking for. Instead, look at my model entries using FFEGs, using pointers, and it's going to save you so much more fucking losses. I promise you, you'll perform way better. Now, if you're taking one trade a day, then sure, use a daily bias, but really all you're doing is this, except once, right? We do this over and over and over and over again, okay? So there we go, kind of a brief explanation into it. We took our low here, but this whole move isn't because of this low. Understand that it's not because of this low, it's because of all of the lows that preceded it. And then we get the conditions at the untapped FFEG, at the FFEG fill, create a new FFEGs, pointer on the inside range. What are we gonna do on our way to the upside? Are we going to have a static target? Of course not. Fuck no. We're going to exit on the conditions that would say reversal or chop. It's as simple as that. Your bias needs to be way more open-minded. Any high and any low can sponsor a move. And from that, we can manipulate, continue, or consolidate. Study the symptoms for the manipulation. Study the symptoms for the consolidations. Study the symptoms for the continuations. Don't worry about looking at a high saying I'm bearish off the high now. Oh, I took the Asia low, now I'm bullish. Oh, I took the London high, now I'm bearish. Like, this shit is trash. It's trash. Okay? Because a buy-side draw on liquidity does not always mean move to the downside, right? It doesn't always mean that. What if there's no orders there? What if there's no limits there? You're going to get a continuation model. All of you guys have seen continuation models, yes? You've all seen it. All of you have seen continuation models. That disproves the buy-side always moves to the downside. It should if there are orders being filled at the high and the stop losses are maintained and not taken out. Sell-side sweep should move to the upside if you are supporting those orders still. But not always. So stop approaching the market like that. I understand it's easy. Just because it's easy to understand does not mean it works, okay? So there's a little brief intro into why I don't use daily bias anymore. People ask me why I took down the video. It's because I think it's misleading, realistically. It's not what I do. I did it like a year ago when I traded options. I moved to futures. I take like 15 trades a fucking day. So yeah, I'm not going to keep that up. It's any high and any low. So there you go. There's your sauce. I'm going to go do some lines.